Tomorrow morning at 8:30 a.m. Eastern Time, something will happen that could move trillions of dollars in global markets within seconds. Stocks could explode higher, or they could collapse instantly. Bond yields might spike. Mortgage rates could jump again. And traders on Wall Street will either make millions or lose millions in a matter of minutes. What causes that chaos? A single number: inflation data. More specifically, the Consumer Price Index, also known as CPI. But here's what most people don't understand. CPI days are not random market reactions. Professional traders already know exactly how to position for them. And there's a very specific trade setup that hedge funds use to profit from inflation shocks, whether markets go up or down. Retail investors almost never hear about it. Not because it's illegal, but because understanding it requires seeing how three markets move together at the same time: stocks, bonds, and interest rates. Today we're going to break down why CPI reports move markets more than almost anything else, how Wall Street predicts inflation surprises, the three assets that move first when inflation hits, and the simple trading framework professionals use on CPI days. If you understand this, you'll never watch an inflation report the same way again. Let's start with the one question that actually matters. Why does inflation data control the entire market? Inflation isn't just about prices going up, it's about how central banks react. And central banks control the price of money itself. In the United States, that power sits with the Federal Reserve. The Fed has two primary mandates: maximum employment and stable prices. Stable prices essentially means keeping inflation under control. The Fed's target inflation rate is roughly 2% per year. But in recent years, inflation has exploded far above that level. At one point, CPI inflation hit over 9%, the highest level in 4 decades. That forced the Federal Reserve to do something extremely aggressive. They started raising interest rates faster than at any point since the 1980s. And those interest rates affect everything: mortgage rates, credit card interest, business loans, corporate profits, and ultimately stock market valuations. When interest rates go up, borrowing becomes expensive. Companies slow down hiring. Consumers spend less. Economic growth weakens. And stocks usually fall. But when inflation cools down, the opposite happens. Markets start expecting rate cuts. Money becomes cheaper. Liquidity increases. And stocks tend to rally. So every month when CPI data comes out, the market is essentially asking one question: will the Federal Reserve tighten or loosen financial conditions? That's why the reaction is so violent. But here's the twist. By the time CPI is released, Wall Street has already made its bets. Because the smartest traders aren't reacting to the data, they're trying to predict it before it happens. Inflation data might seem mysterious, but large trading firms use a huge web of indicators to estimate where CPI will land. They track things like energy prices, shipping costs, commodity markets, wage growth, housing data, and consumer spending. One of the most important inputs is oil prices. Energy costs feed into transportation, manufacturing, and food prices. So when oil surges, inflation usually follows. Another key indicator is wages. If wages are rising quickly, businesses often pass those costs to consumers, which pushes inflation higher. Housing also plays a massive role. Shelter costs make up over 1/3 of CPI calculations. So, rising rents can push inflation up even if other prices are stable. Hedge funds combine all of this data using statistical models. They produce their own CPI forecasts, then they compare those forecasts with Wall Street consensus estimates. And here's where things get interesting. Markets don't react to inflation being high or low. They react to whether inflation surprises expectations. If inflation comes in higher than expected, markets panic. If inflation comes in lower than expected, markets celebrate. So traders aren't betting on the level of inflation. They're betting on the surprise. And when that surprise hits, the first market to react isn't stocks. It's something most retail investors barely watch: the US Treasury bond market. When inflation data drops, the first market to move isn't equities. It's the US Treasury bond market. The Treasury market is the largest and most liquid financial market in the world. It's where governments, banks, hedge funds, and pension funds trade debt. And it's the center of the global interest rate system. When inflation comes in hot, traders immediately assume the Federal Reserve will keep rates higher for longer. That causes bond yields to spike. And when yields spike, bond prices fall. When inflation is lower than expected, the opposite happens. Yields fall, bond prices rise. And here's the critical connection. Bond yields directly affect stock valuations. Higher yields make bonds more attractive compared to stocks. Lower yields push investors toward equities. So when Treasury yields move, stocks usually follow seconds later. This is why professional traders often watch bond futures during CPI releases. They move first. Then stock index futures react. But there's another asset that often moves even faster: the US dollar. Inflation surprises don't just affect stocks and bonds. They also move currencies. The reason is simple. Interest rates determine currency strength. Higher interest rates attract global capital. Investors move money into the country, offering better yields. That increases demand for the currency. So when inflation comes in hot and markets expect higher rates, the US dollar usually surges. When inflation cools and rate cuts become likely, the dollar weakens. This creates a chain reaction across global markets. A stronger dollar can pressure emerging markets. It can push commodity prices lower. And it can tighten financial conditions worldwide. A weaker dollar does the opposite. It boosts global liquidity and risk appetite. This is why CPI releases can move not just US markets, but markets everywhere. But now we get to the part most people never hear about. Because while the news focuses on whether stocks go up or down, professional traders focus on something else entirely: volatility. CPI releases are one of the most volatile moments in financial markets. Stocks can swing 1 to 3% within minutes. Options prices explode. Liquidity disappears. And price gaps appear instantly. For most retail investors, this looks terrifying. But for professional traders, volatility is opportunity. Instead of betting on whether markets go up or down, many hedge funds bet on how big the move will be. This is done using option strategies. One of the most common setups around CPI is something called a straddle. A straddle involves buying both a call option and a put option on the same asset. That means the trader profits if the asset makes a large move in either direction, up or down. All that matters is magnitude. Let's imagine the S&P 500 is trading at 5,000 before CPI. A trader might buy a 5,000 call option and a 5,000 put option. If CPI triggers a massive rally, the call option gains value. If CPI triggers a market crash, the put option gains value. Either way, the trader wins if the move is large enough. This is why CPI days often see huge spikes in options activity. Professional traders are positioning for explosive moves. But there's a catch. Options prices already factor in expected volatility. So traders need the move to be bigger than the market expects. That's the real game. And it leads to one of the most fascinating dynamics in modern markets. Before every CPI release, options markets price in an expected move. For example, traders might estimate that the S&P 500 will move plus or minus 1.5%. That becomes the market's consensus volatility expectation. If the move stays within that range, many option strategies lose money. But if the move exceeds expectations, traders positioned for volatility win big. This is why professional desks analyze something called implied volatility versus realized volatility. Implied volatility is what the options market predicts. Realized volatility is what actually happens. When realized volatility is higher than implied, volatility traders profit. And CPI days are one of the few events where realized volatility can dramatically exceed expectations, especially when inflation surprises. But sometimes, something even stranger happens. Sometimes CPI data looks good, yet markets crash anyway. To understand why, we need to talk about positioning. Markets don't just react to data. They react to how traders are already positioned. If most investors are betting on lower inflation, then markets might already be pricing in a bullish outcome. In that case, even a positive CPI number might not push markets higher. Why? Because everyone who wanted to buy already bought. This is called crowded positioning. And when positioning becomes extreme, the probability of a violent reversal increases. Good news can cause sell-offs. Bad news can cause rallies. Because traders are forced to unwind positions, professional trading desks track positioning through several indicators: options flows, futures positioning, fund exposure, and sentiment surveys. When positioning becomes extremely one-sided, the probability of a violent reversal increases dramatically. This is why CPI days can produce some of the most confusing price action in markets. But there's one more layer to this story, and it involves something happening behind the scenes at the Federal Reserve. While markets obsess over CPI headlines, the Federal Reserve focuses on something slightly different: core inflation. Core inflation removes volatile components like food and energy. This gives policymakers a clearer view of underlying price trends. Sometimes headline inflation falls while core inflation remains stubbornly high. When that happens, markets can misinterpret the data. They celebrate falling inflation, but the Fed remains cautious. Because persistent core inflation means price pressures haven't truly disappeared. This disconnect can create major market whipsaws. Stocks rally, then suddenly reverse when investors realize the Fed may not cut rates anytime soon. This is why professional macro traders break CPI reports down line by line. They examine shelter inflation, services inflation, goods inflation, energy prices. Every component matters, because each one tells a different story about the economy. And sometimes the story changes everything. When a CPI surprise hits, markets don't move randomly. They follow a very specific sequence. First, Treasury yields react. Bond traders instantly reprice interest rate expectations. Then the US dollar moves. Currency traders respond to shifting rate differentials. Then stock index futures explode higher or lower. And finally, individual stocks react. But the magnitude of the move depends on something else: liquidity. When markets are thinly traded, price swings become much more violent. During high liquidity periods, moves can be absorbed smoothly. But during low liquidity moments, even small surprises can trigger huge reactions. This is why CPI releases often produce sudden spikes and reversals. Algorithms dominate trading during those seconds. Human traders can barely react. But if you understand the structure behind these moves, you can start to see the patterns forming. And that leads to the final insight most retail investors miss. The most powerful CPI trade isn't predicting inflation perfectly. It's understanding market expectations. Because markets move based on the gap between reality and expectations. If inflation comes in exactly as predicted, nothing dramatic happens. But if it surprises even slightly, markets can swing violently. Professional traders spend enormous amounts of time studying forecast dispersion, options pricing, market positioning, and interest rate expectations, all to answer one question: is the market underestimating the potential surprise? When the answer is yes, volatility trades become incredibly attractive. And this is why inflation reports continue to dominate global markets. Because every month, the entire financial system pauses for one moment. waiting for a single number. A number that determines whether interest rates rise or fall, whether mortgages get cheaper or more expensive, whether stocks rally or crash, and whether trillions of dollars move across the world's markets in seconds. But here's the truth most headlines ignore. Inflation data doesn't just reveal what happened in the past. It shapes what the future of money will look like. And in markets, the future is the only thing that matters. Over the past decade, investors learned one powerful lesson. The Federal Reserve is the most influential force in global markets. But the Fed itself reacts to something else: inflation. That means every CPI report becomes a window into the future of interest rates, the future of borrowing, and the future of financial markets. So the next time inflation data is released, don't just watch whether stocks go up or down. Watch the bond market. Watch the dollar. Watch volatility. Because those signals often reveal what smart money is really doing. And sometimes the biggest opportunities appear exactly when everyone else is focused on the wrong thing.